Welcome to this week's Ben's Market Insights. So much to talk about this week. I think the key element to discuss is the investor concerns and jitteriness over stagflation and the oil price shock. Are we back to the 1970s in a very similar format? The answer, I believe, is no, but let's go through the numbers and see how that pans out. If you're enjoying this type of content, please subscribe to our YouTube channel, Ben's Market Chat, and give us a thumbs up. Thank you very much. Let's go back to sort of basics a little bit and understand the global oil market. So the US is the world's biggest oil producer. They produce some 13.5 million barrels a day. That's 15% of global oil production. But 60% of, so you imagine they'd be self-reliant, but actually 60% of that refinery feedstock is imported mainly from Canada and Mexico because of the type of gasoline that the US market demands. Typically, 20% of the global oil production goes through the Straits of Hormuz, which is, despite President Trump's comment last night suggesting that the war is coming to an end, remains closed. Now, what's interesting is that 80 to 90% of that Hormuz traffic goes into the Asian markets, of which half finds its way to China. That's quite interesting because if you remember, a couple of weeks ago, the US lifted sanctions on Russian oil heading to India because India is some 15% of that Hormuz traffic. So there was already some pre-planning going ahead. Now, China clearly would suffer in this scenario, but they do have some 100 days of reserves in place, and that will keep them going for at least 3.5 months or so. But thereafter, clearly things start to look pretty grim from a China economy marketplace. So clearly the US is suffering from pricing, but it's not suffering from supply. China is potentially going to suffer from both if this war continues for much longer. So in a sense, the US is winning its kind of geopolitical plan of isolating Iran and one of its supporters, and clearly one of US's key sort of economic enemies, at least, in the form of China. Now, it is worth keeping in mind that clearly every 10% move in the oil price, and at one point yesterday went up to $120 per barrel, it's now back towards the 90 level, so extreme volatility. But for every 10% move in the oil price, that's a 25 cents impact on gasoline prices in the US. Now, directly, energy accounts for some 6 to 7% of the inflation basket in the US. So you'd think not a huge impact, but clearly there are effects from the logistics train, if you like, and supplies, because all of those using diesel, etc., will feed their increased costs of energy back into food prices, etc. So it is inflationary. There's no way of getting around that. Now, if you then couple that with the impact of what we saw on Friday, which is essentially that new jobs added were actually negative 90,000 or so, that is not helpful, because what that now presents is an environment potentially of higher inflation and lower economic growth. And that unemployment number, or rather employment number, hasn't shifted. We haven't had new jobs being created in the US for at least since Liberation Day, which was last April. So it is almost a year since we've had new job creation. Now, unemployment isn't really a problem at this point in time, at around 4.4% or so, but it is ticking higher. However, it remains near full employment. So it is an issue. And if we continue to see this process of war continuing, then that unemployment is more than likely going to tick up. One could argue that in the short term, the very bad weather in the US over the December, January, February period may well have contributed to the lack of job creation, but it's certainly something to keep in mind. Currently, consumer confidence is not getting affected because it is a war far away. A ground offensive would certainly fray consumer confidence. I can't imagine that we are going to see a ground offensive. It is way too invasive from a confidence and economic perspective as far as the US is concerned. But it does look like the US Fed under Kevin Warsh is very likely to reduce interest rates as soon as he comes on board in May in order to get this economy moving faster. Now, the inflationary issue from higher energy prices could to some extent be equalized by the strength of the US dollar. So as this war has really evolved, what we've seen is a move to defensive currencies, of which the US dollar is one. Now, as the US dollar appreciates, clearly imported goods are cheaper, and that's a deflationary impact on the US economy. So potentially we get to May where there is a long tail to this war. It's not as impactful as it is currently, but it continues in terms of airstrikes, etc., from both the US and Israel. But what that then implies is an environment where we don't have a huge amount of inflationary pressure thanks to this equalization effect, allowing the Fed to go ahead and reduce. And certainly the 10-year bond at around 4.1% is supportive of further reductions. I would say as well that President Trump clearly understands the implication of a continued offensive in Iran would not be helpful for his chances in the midterms come November. Already, the Republicans are facing a huge uphill climb in trying to win the House, and continued offensive in Iran would potentially bring the Senate into question as well, and thereafter all sorts of bad things could happen in terms of impeachment and all sorts of other things that really Trump doesn't want to go there at all. So I think he's going to be very keen to cut the losses, winnings, whichever way you want to look at it, pretty quickly. Now, let's turn very quickly to markets and see in terms of asset allocation where we are. I'm going to throw some numbers here, so just be kind of cognizant, just simply because the S&P index the 500 index in the US is down some 2.2% since the start of the year, but the changes under that from a sector point of view have been immense. So the biggest sector, of course, is technology. That's down some 5.5% and continues to account for some 28% of the S&P index. What's interesting, even within technology, you've had software down some 25% at its lows, but it's bounced back up again some 15% in the last week, whilst the semiconductor index, which was at a high of 18%, is now only up 11% or so since the start of the year. So even within technology, there's been a huge amount of movement. Energy, not surprisingly, 5% of the index is up some 25% year to date, but falling away a little bit. Financials, which are 18% and the second biggest segment, are down some 11%. Pharma, 10% of the index, down 5%. Industrials, 9% of the index, up 5%. Commodities, again, not surprisingly, very small part of the index at only 3%, were up 18% prior to the war and now up only 8%. So really fallen back significantly. Consumer staples were up some 10%, but prior to the war and now up some 15%. That's some 5% or so of the market. So overall, at the index level, we really haven't seen a huge amount of movement, but there's been a tremendous amount of activity below. So where next? My personal perspective, with interest rates falling, we're going to be back to thinking about technology. Valuations are much better in the sector now. The AI trade hasn't gone away, and that is only going to continue to allow for further growth. Please look at our episode from last week talking about the oligopoly that exists in data centers means that pricing for AI is going to not fall. It's not going to be competed away, and margins are going to continue to improve significantly as this capex works its way through the data center players, and those are Alphabet, Microsoft and Amazon. If there are inflationary pressures, and clearly again tech is a beneficiary, a slowdown in the economy makes tech again a beneficiary, with much greater moats around their business. And of course, lower interest rates, which again I would expect would imply that the financials come back. I would be very wary of the energy sector. I think these are at dangerous levels. These are at panic levels. And as we've discussed earlier, in terms of supply for the US market, there is no particular issue. Overall, if the Straits of Hormuz open up in the next month or so, the global panic will recede. I'll leave it there. Thank you very much and enjoy your week.